Okay, in this week's financial podcast, the topic for today is what legal entity should I set up for my business? And I'm so thrilled to have Mark Chaves. He's an international tax partner and leader of the international tax practice at Marcum LLP, and he's actually in the Miami office. Mark has over 20 years experience in public accounting and is responsible for assisting clients with domestic and international tax planning, structuring mergers and acquisitions, and business reorganizations. Prior to joining Marcum LLP, Mark was a founding partner at Chaves and Armstrong PA, a firm with expertise in international tax, technical accounting, and complex audit services. It was actually merged into a regional accounting firm called Daskell Bolton LLP. He also served as senior international tax manager at PricewaterhouseCoopers LLP, focusing on all facets of cross-border tax planning, tax-efficient structuring, business mergers, acquisitions, and reorganizations. Mark, I'm so thrilled to have you on the show, man. We go back many, many years. In actual fact, Mark does my personal taxes for decades now. So for all of those services over the years, Mark, thank you so much. Thrilled to have you on the show.
Oh, absolutely. My pleasure to be here. Thanks for the invite, Richard. So if we can provide some value and educate some folks, I'm all about it.
Fantastic. Fantastic. I know you have that way about you, Mark. All right. So, Mark, let's kick it off. What are the key factors that entrepreneurs should consider when deciding on the most suitable business entity for their specific situation?
Well, sort of outside of any regulatory considerations or legal issues, I'd say the next important consideration is taxation.
Yes.
And, depending on the legal entity type, it could really make a difference in terms of the ultimate tax bill for either the entrepreneur or the company itself.
Right.
So I would say that's probably the second point once you cross all the legal hurdles as to what type of entity and any licensing constraints or anything along those lines.
Absolutely. So, and it can have a significant impact on operations, as you mentioned, tax liability and overall structure as well, right? I'm going to get into some of the legal liability issues. There's not a legal conversation. It's more of a tax one, but that is a big factor. And then, of course, it's based on various factors as well, Mark, like your business goals, your size of your business, the industry you're in, and the level of control and liability that you're comfortable with.
Sure. Yeah, absolutely.
Absolutely.
Not all entity types shelter you from legal liability. I'm not an attorney, so let me put that out there up front.
Yeah.
But you sort of have to factor in the legal and the operational aspects before you come to a decision.
Absolutely right. So let's kick it off here with briefly explain, Mark, the various types of business entities that exist, such as sole proprietorship, partnerships, LLCs, S Corps, and C Corps, and just what they are from a taxation standpoint, what they entail, just the very basics at 100 feet. Let's do that.
Yeah, so 100 feet, in the US, there's a limited liability company, which is the LLC, very commonly used, probably more commonly used than any other entity type. There's the LP, the limited partnership, which is not as commonly used, but it's still out there, or the corporation, which obviously is used quite a bit. The LLC and limited partnerships are by default what we call pass-through entities for US purposes. So that means any profit or tax liability for tax purposes goes onto the owner's personal tax return.
Yes.
Whereas a corporation generally pays tax at its own level.
Yeah.
And then the owner takes any income tax if there's a distribution or salary from the corporation. Yeah. There's one other wrinkle called an S Corp, which is a small business corporation, which you would have to make an election for, but that also, the income from that also passes directly to the shareholders' tax return. So that's those are the general choices,
right,
from a tax standpoint.
Right, and entrepreneurs may choose none of those. They may just want the sole propriety route as well, right? Sole proprietorship. So, I mean, that one there, it's the simplest form of business entity, I guess. Tell us a little bit more, a 30-second view of that route.
Yeah, so a sole proprietor, there's no entity, right? You're just sort of conducting business in your own name or as a doing business as a DBA. The problem with that is, you're taking on all the liabilities of the company because there's no legal shelter, there's no entity to shelter the business.
Yes.
So you typically see that a lot in sort of consulting services where people are providing consulting under their own names and they don't want to go through the hassle of setting up a company. But most attorneys you speak to will probably recommend you have some type of an entity to shelter you from a legal liability standpoint.
Absolutely. And so just go a little slowly now about legal liability to each of these entities. So let's go with an LLC, which is a common form of entity here in the US. So what does that offer in terms of protection against legal liability? And is there flexibility that they can be taxed, as a disregarded entity? I'm sure you'll explain that. Partnership, an S Corp or a C Corp. Just tell us a little bit more about LLC and what it affords us.
Yeah. So I can't speak directly to legal liability because I'm not an attorney and
Yes. Yeah.
I cannot give legal advice.
Yes.
But in general, yes, a limited liability company is a separate legal entity that you would have to register under state law,
Yes.
depending on what state you operate in. And as I said, the LLC by default is treated as what's called a pass-through. So if you have an LLC with one owner, then that's considered a disregarded entity, which means the entity has no personality for tax purposes, and it's basically ignored for tax purposes, for income tax purposes, and everything sort of passes up to the owner's tax return. If you have an LLC with more than one member, from a taxation standpoint, that's treated as a partnership, which means that the entity is no longer disregarded. So it's a separate, that entity has its own filing and its own tax reporting structure, but any income still sort of flows right up to the owner's tax return as well, right? It's still a pass-through entity. And as a limited liability company, there's still some level of legal protection because it's still legally formed under state law. An LP, limited partnership, also a separate legal entity, formed under some state statute, and taxed in very much the same manner as an LLC with multi-members, with more than one member, meaning it's a pass-through entity. Everything flows up to the owner's tax return. So if you have, say, 3 members of an LLC and they agree to split profits 33.3% each, then that percentage would flow up to each individual's tax return and, they report it. It's still a separate entity. So there's still some level of legal protection, whether, the legal liability that an LP provides is better than what an LLC provides. I'm not sure. I mean, typically they're very similar from what I understand, but, as I said, I'm not an attorney, so I can't really advise on the differences in that.
Understood.
When it comes to the corporation, sorry, Richard.
Go ahead.
One more is also separate entity, commonly used, has to be incorporated under, the state statutes as well. Corporations typically are not pass-through entities, which means they have their own legal and they have their own tax personality. Any profit earned by the corporation is taxed at the corporate level. So the company is going to have to, pay its own taxes. And if the shareholder takes a dividend distribution from the corporation, the shareholder would be taxed again as a dividend. So you often hear that a corporation provides double taxation or results in double taxation. That's what it's referring to. The company is going to pay, and any distribution from the individual to the individual is going to pay again. So most small businesses you would see set up as an LLC or some type of a pass-through structure. Or I had mentioned earlier, corporation, you can make an election to be treated as a small business corporation or an S corporation. Works very similarly to a limited partnership or an LLC, where everything sort of flows right back up to the owner, and there's no double taxation in that standpoint.
Beautiful. Well explained there, Mark. Thank you. So when do I cross the line between an S corp and having to establish a C corp?
I would say, most small businesses uh, they're probably better off as an S corporation, right? For the same double taxation issue that I just talked about. There are some advantages to setting up as a C corporation. If you have international sales, for example, there are lower corporate tax rates attributable to profit on the international sales. So, for example, we're here in Florida. There's a lot of distribution companies. They buy and sell, into Latin America or globally. So a corporation could work quite well, under those circumstances, because profit on those sales, instead of being attributed a tax rate of 21%, it's actually dropped to as low as 13.1%. And those rates are scheduled to go up in a couple of years, but still there's some benefit to taking advantage of that now. And there's also what a lot of folks overlook is that a corporation, a C corporation, meaning not an S that is a pass-through, there's a benefit on sale. So if at some point you sell the shares of a C corporation, there's actually an exemption. It's called the small business stock exemption. And, it could be, $10 million or above, assuming you meet certain criteria. The company has to be in business for 5 years. It always had to have been a corporation from the get-go. So, depending on your exit strategy and entity type and size of the business, you should look at a corporation. It's not, don't dismiss it because there's a double taxation element, right? And don't dismiss it right off the bat. There could be some benefits to operating in a corporate structure.
Got it. And is there a limit, Mark, to the amount of shareholders I can have in an S corp, which then crosses the line into a potential C corp?
Yes. Yes. Well, yeah, that's a good point. I mean, an S corp is limited to the number of shareholders. I believe it's 75. And also an S corp cannot have foreign shareholders. So if you would like, if you have family members or you would like a foreign investor, right away you cannot operate as an S corp because you'd be prohibited from having any type of foreign investment. So yeah, that is a very good point.
No, absolutely. And so how flexible is all this? Because, I can start a business. I think I'm going to be, I'm going to grow it to $1 billion. That and every visionary has those grandiose dreams, right? As they should. But then I start off with an LLC, or I may elect for an S corp, and then things change. How flexible is it along my path, to growing companies, to change the entity structure, to change from an LLC maybe to a C corp, or an S corp to a C corp? How flexible is the tax regime to enable me to do that?
So if you're moving from an LLC treated as a pass-through entity or a limited partnership, which is a pass-through entity, and you want to operate as a corporation, so it's called, the incorporation of a partnership. From a tax standpoint, that can be done on a tax-free basis. So you can just make an election or convert to a C corp, and there's no tax cost of doing that. If you want to go from a corporation, even an S corporation or a C corporation, which is not a pass-through, and you want to sort of convert to a limited partnership or an LLC type entity, that's a taxable event. So even if it's basically treated as a sale of the company assets, and the individual is treated as having sold the company shares, so it's much easier to go from the former, from a pass-through to a corporation, but there's a tax cost potentially going from a corporation back to an LLC or an LP. So I almost say a corporation is almost a one-way street, right? Once you elect, or if you're going to operate as a corporate entity or as corporate status, you got to consider tax consequences before converting to another entity type.
Got it. Got it. Okay. And so for someone, Mark, just starting a business, what are the initial steps that they should take when deciding on a business entity?
Well, I would consider exit. So what is your exit plan? Is it something where you're looking to, pass the shares on to family members or kids? Are you looking to grow the business and exit after 5 years? So what is your medium or long-term plan, right? And if the idea is, hey, I want to grow this business and sell the shares and cash out, then you should certainly look at operating as a C corporation. Because as I said before, there's this exemption, small business stock exemption, if you meet certain criteria. And so, that's one important factor for sure. And, do you want to take profits out of the company? Certain businesses, certain owners want to sort of reinvest the profits inside the company and not really take, on an annual basis or take all the profits available. So if you're operating as, say, as an LLC or as a limited partnership, keep in mind those are flow-through entities. So you're taxed on your share of the profit, whether or not you take a dollar out. So, for example, there are a lot of businesses that, their cash or potential cash is tied up in receivables, right? So customers, take a while to pay. So, potentially you could be taxed on that profit, even though you haven't gotten the cash as yet, if you're in a pass-through structure. So, we often, tell clients, hey, what's your long-term plan? Are you looking to take profits out? And that could be a big distinguishing factor between an LLC or a pass-through type structure and a corporate type structure.
Got it. And how would you kind of not advise necessarily, but you've got an entrepreneur starting off, early stage accounting and so forth, typical on a cash basis. All right. And then they've got to progress at some point to, more accrual basis. What would your kind of recommendation, suggestion be in terms of the get-go? Do they start off and is an advantage on a cash basis and then moving to accruals? Or should they just try to get their books and records straight and go with true kind of GAAP financials for tax purposes?
If you're a small business, I would say cash basis is fine, right?
Yep.
I mean, and most businesses operate that way that are small, or if you're, say, in a consulting business, it's a lot easier to manage. You're being taxed as you're earning money, so you're not being taxed on income that you may not have received yet. But once the business starts to grow, and you hit certain revenue thresholds, from a tax perspective, you're going to have to switch to an accrual basis. So as startup entrepreneurial type company up front, the first few years, as you're building the business, certainly I would say cash basis is the way to go.
Can you share the revenue threshold where accrual basis or GAAP basis becomes necessary?
Yeah, it's a $25 million threshold. So, if you're being audited, for example, or you're going for some type of bank financing, a lot of banks require that your financial statements be audited by an independent CPA firm, or there's some type of review opinion that is expressed. You're at that point in time, you're likely going to be under the accrual method, right? So, but as a startup type and in the initial stages, certainly a cash basis financial statement would work well and probably be better from a tax standpoint as well.
And let's pick on 25 million above. Mark, should the business person, should they be thinking about a set of financial records for tax purposes being prepared, compiled, reviewed by an outside accounting firm? Or, I mean, what's the substance behind that now as they kind of move when they start to grow?
Yeah. In my experience initially, most companies would have sort of an external bookkeeper, right?
Yeah.
So,
Yeah.
No one really, at least at the initial stages, can really afford to bring on, a full-time or a full charge accountant and controller and an internal staff. So at the initial stages, yeah, a full-time bookkeeper to sort of manage your accounting software and could have online access, provide you with the reports, on a weekly or a monthly basis. But certainly as the business grows, particularly if there's inventory involved, and you really need a dedicated, function more on a full-time basis, then at that point, definitely look to hire a person to come in on a full-time basis. Typically if you outsource that entire function to an outside firm, it's going to be less cost effective for you, right? So in initial stages, if you need some bookkeeping done, and not necessarily 40 hours a week, or it's not a full-time gig, but as the business grows, if you need to invest in a good accounting team and a good software to manage the accounting aspects for the company, certainly look at that. Now, is there ideal timeline? I think it really depends on the business and the business type, and what type of hours you really need to manage the accounting function properly.
Yeah.
Once you start hitting the 30 to 40 hour threshold, certainly look to get someone in house. I think that'd be a lot more manageable.
And we're going to get into the risk on tax audits, etc. So we'll talk a little bit more about that in a later segment here. But in terms of filing the tax return and having a Marcum LLP, sign as preparer of the tax return, but based on internal financials, how would you kind of bifurcate when the right time is, right? There could be a full set of financials. It could be reviewed by an external, accounting firm, or it could be done internally. But now you've got a firm who's basically signing off on the preparation. Does that help from an IRS standpoint, or what? I mean, that you have the external firm basically putting a stamp of approval, even though it may be internally generated financials.
Yeah, from an income tax preparation standpoint, unless you're a really large company,
Yes.
you're likely not investing to bring your own tax professional or tax director or tax manager in-house to prepare tax returns. That really is once the company is quite large. Most businesses, an outside preparer prepares the tax returns. Now it could be a firm the size of Marcum, or an outside preparer that is a sole practitioner, but I would not recommend looking to bring that function in-house and hiring a tax person in-house until the company is larger and a lot more complex. It'll be a lot more cost efficient to really have the tax function prepared externally. Because if you're going to bring that in-house, you're really looking at tax software that you're going to have to license. You have to pay for, tax preparer, tax manager. You would likely want that return reviewed anyway. So it's not as cost effective to do it on the tax side as it is to bring sort of the core accounting function in-house. Right? The tax prep, I think, can be, outsourced for a while, but internally for the accounting or day-to-day accounting, it is typically more cost effective to bring that function in-house.
I will appreciate that, Mark. Okay, all right. I know we were talking a little bit about the journey of growth. So let's take the conversation back left a little bit, which is about type of business entity, right? So how does each type of business entity impact taxation, both at the federal and the state level? And you can keep it fairly high level. I know there's a lot of nuances and there's a lot to unpack in that question, but just at a high level, because we're talking taxation generally, but there's a number of taxes that businesses have to kind of tend to. But at the federal and the state level, how does the entity kind of somewhat dictate the taxation, you know?
Yeah, it gets back to one of the core questions is the company considered a pass-through for tax purposes or not? If it is a pass-through, then the tax rate on those profits at the federal and state level is really going to depend on the level of the individual tax rate.
Right, yes.
Right. So individual tax rates from a federal standpoint now goes up to 37%. And in Florida, there's no individual income tax. But in certain states they are, in most states they are. So, depending on the level of profit, the tax rate on that can go anywhere from 10% up to north of 40%,
Yeah.
right? If you're a non-pass-through company and you're a corporation, the federal tax rate at the corporate level is capped at 21%. So it doesn't matter if it's $1 of profit or $100 million of profit, it's 21% tax. And there's also state taxation at the corporate level. In Florida, for example, there may not be individual income tax, but there is at the corporate level at 5.5%, and most other states have some type of an income tax or gross receipts tax. So it's really a function of comparing those rates initially, and then the second is you're looking to take profits out, or are you really looking to reinvest it? Because let's say you're in a corporation and you pay federal tax at 21% or Florida at 5%, but you really are looking to invest the company profits and not take distributions out. If the company is profitable, you could potentially save 7, 8, 9 percentage points versus if the company is a pass-through, because if the company is a pass-through, you're being taxed at the individual rates, whether or not you take $1 out, right? So this disparity in corporate rates and individual rates is a big factor in that determination.
That is awesome. All right, so now we're really warming up, because this is about obviously there's a compliance piece of this, there's a tax planning piece, which is a couple of aspects of taxes, but business people want to be tax efficient legally, right? So we're going to get into a little bit about that a bit later. So far, just to recap, we've covered the different types of entities from a tax standpoint. We've talked a little bit, although we're not advising really on the liability implications and how that can impact an entrepreneur's personal assets, all right? Somewhat protected in an LLC or corporate structure, not the case in potentially a sole proprietorship or general partnership, right? We talked a little bit about the concept of pass-through taxation and how it relates to certain business structures. So, Mark, can you provide some examples of situations where one business entity may be more advantageous than another for tax purposes?
So let's say, for example, you do a lot of international sales, right? And this is quite common in Florida or Miami specifically. Yes. So if you're selling internationally and it's a profitable business, the corporate rate on those international profits, instead of being 21%, could potentially be as low as 13.1%, yes. Right? If it's a corporate entity. Now, consider the same level of profitability, but in a pass-through type structure, where all those profits are flown up to the individual. and taxed at the individual corporate rate. The individual rate, which may be as high as 37%. Now, there are certain deductions that are available for pass-through type entities. One's called the QBI, the qualified business, where there's a 20% deduction for just operating as a pass-through. But there are limitations to that. It's limited to the level of wages. So I would say if you're an international business, for example, and fairly profitable, you might want to take a hard look at operating as a C Corp and benefiting from a lot lower rate initially, particularly if you're going to be reinvesting profits into the business versus a pass-through. There could be significant deferral or significant savings year over year, because each year's profit is going to be taxed at a much lower rate. Whereas, as I said, if it's a pass-through entity, the individual is paying tax whether or not a dollar is taken out of the business. So that's a very important consideration.
I love the wisdom bites. That's fantastic, Mark. All right. And so are there any industry specific considerations that can influence the choice of business entity?
Industry specific?
Yes.
I would say consulting, if you're in sort of a consulting business. Professional services.
How do those impact the choice of entity?
Yeah. So, for example, a lot of professional services, you don't necessarily benefit from this 20% pass-through deduction that I discussed. So, could it still be beneficial to operate in a pass-through structure? Yes, particularly if you're going to be withdrawing, profits regularly from the business. But I would say mostly from, if there's any type of regulatory considerations, right, that would drive one entity type over another. But, from a taxation standpoint, your revenue and your expenses, it's really the bottom line that sort of drives what your entity type is going to be. So you see, businesses in different industries, are set up as pass-throughs or as corporations. I wouldn't say it's really an industry-specific type consideration.
Got it. Okay. All right. And so we've been focused on federal and state taxation. Mark, what are the various categories of taxes that businesses must prepare for? Now we're talking about potentially not just corporate taxes and so on, but there's sales tax, sales use tax, payroll tax. Just rattle a few off, because it's not just, federal and state taxes that end up on your tax return. There's all these other taxes businesses have to start to think about, right? Depending on
there's income tax, right? So, which is tax on your profits.
Yes.
There's payroll type taxes. So if you hire people, there's FICA, Medicare you got to worry about, and 6.3% or 1.29%. So those are, there may be licensing fees depending on if you're incorporated in some districts or municipalities that you need to worry about. As you mentioned, sales and use tax. Yeah. So if you're selling product, you typically got to collect from the customer any sales tax and remit it. Sales tax is not generally a company expense because you're collecting it from the customer and remitting it to the government. But there are numerous exceptions to having to charge sales tax. For example, if you're exporting out of state, or if you're selling to a company that's buying for resale, you got to get a certificate from them. Sales tax, Marcum has a state and local group. Sales tax is an area where you see people run into hiccups all the time, because the documentation is typically not up to date, or they're not collecting sales tax and remitting when they should be. So that's one area I think that you really need to make sure you're 100% compliant in.
Right, you're buttoned up. Okay, all right. So what are the most common mistakes or misconceptions you see regarding the selection of business entities, and how can listeners avoid them?
I would say probably the most common is thinking that if you set up as an LLC, then the company is a taxable entity on its face. So I get questions all the time. Oh, I set up an LLC and I know I have to file a tax return and pay tax at the LLC level. And we often tell them actually no, because single member LLCs are disregarded, as I had talked about earlier. So everything just kind of comes up to your own tax return, and there's no filing at the company level, at least no income tax filing. And they're like, "Are you sure? Are you sure about that?" I'm like, yeah, we're pretty sure. So that's probably the most common misconception is because you have an entity, it means the entity is itself taxable right off the bat. But that's not the case in the case of an LLC.
Got it. Got it. Good one. Okay. All right. And so let's talk a little bit about record keeping. We touched on it earlier. And so what must businesses do in their record keeping accounting to keep the entity status for tax purposes? And so I've got a few follow-up questions, but what must they do to make sure that they maintain the entity status?
Well, I mean, I've seen so often where taxpayers are get into a lot of trouble because their record keeping is very sloppy, right?
Yeah.
And if the business is ever subjected to an IRS audit, the IRS is going to ask for your bank statements, your income statement, sort of what's called your general ledger, which is, the accounting system that keeps track of all your income, expenses, invoices. So certainly don't be sloppy in your record keeping.
Yes.
That's important, number one. And I would say point number two is really keep the business expenses through the business. Don't run all your personal stuff through the business. I've seen companies or entrepreneurs get smacked with that from the IRS because, I mean, is Publix really a business expense, right? So really try to or keep your business expenses in the business, and your personal expenses, pay that stuff from your own personal tax return. Don't commingle the two.
Okay, absolutely, Mark. And that has implications. I know we're not lawyers, but that has implications for piercing the veil and commingling personal and company assets. And then all of a sudden now it gets like a gray zone now. And so some of that
Yeah,
protection
absolutely.
may not support that. And of course, your tax status may not be supported if you start to commingle personal and corporate expenses,
Well, I mean, you get, an IRS agent is going to ask you, if there are certain expenses you picked up on the tax return. Okay, so show me the invoice for this. What's the business purpose of that expense? And for a lot of these expenses, trips and flights and stuff like that are more personal in nature. They're going to be disallowed, and you're going to have to basically pay taxes on that expense that you should not have taken.
Got it. Got it. Okay. And so how long should businesses keep records for tax purposes? That's always a common question, right? I'm sure you get that all the time. Can I
Well, I mean, the
over it or do I
typical
need to?
statute of limitations is
Yeah.
3 years. So from the date of filing. I always recommend, there's certain records that are permanent in nature. For example, if you buy property and you need to establish the tax cost of that. So, important purchases or asset purchases, so certainly keep those records into perpetuity. And I generally recommend, keeping books and records for 7 years. So even though the statute may be 3 years, um, having a healthy timeline of record keeping is very important because you never know when you may have to refer back to something that even for a year that may be closed, by statute, but can still impact the current year. Right?
Correct.
So I would say so. That's a rule of thumb, 7 years.
7 years. And is that for income tax as well as sales tax and other types of taxes, payroll taxes? Would you suggest businesses keep those open for 7 years as well?
Yeah, I honestly I don't know if there's a different statute for sales tax. So, but I'll have to punt on that one. But I do believe, sort of from an income tax perspective, which would cover payroll taxes, 7 years should be adequate.
And what record should businesses keep for 7 years?
Bank statements, customer invoices, supplier invoices, a lot of this stuff could be digitized now, right? So it makes it a bit easier than keeping, warehouses full of boxes. So those are the main items, right? Sort of your typical expense receipts and invoicing receipts that would support what your accounting is saying you have for revenue and expenses, right? Because those are the first things that are going to be requested.
So how deep do you go, Mark? If I kept credit card statements, for example, does that suffice, or do I have to have a restaurant receipt as an example?
You would need a rest. So, for example, if if you ever allow me to, and I take you out to lunch,
Yes.
and I write it through as a business expense, on the receipt, I have to, document your name, the purpose of the, of the lunch, and basically make a note of, the business item discussed. Credit card statements are typically not enough. You actually need to keep the receipt with the proper documentation on it. I've seen taxpayers have expenses disallowed because they're just not retaining these basic elements.
Got it. Okay, all right. And a basic calendar, Mark, tell us when a tax is due.
So individuals typically April 15th.
Yeah.
Entities, partnerships are April 15th as well, but can be extended for 6 months. S corporations, and partnerships and S corps are typically March 15th, can be extended to September 15th.
Yep.
C corporations are generally due April 15th and can be extended to October 15th. Keep in mind, though, that the IRS wants to be paid in full by April 15th. So, to the extent, there's a misconception that if you extend your tax return, that extends the time to pay. That's not the case. You can extend your return, but you need to pay what's due by the due date, which is April 15th. Otherwise, there's interest charges and potential late payment charges as well, depending on whether you paid in enough, at the time of extension.
Got it. Okay. So let's talk a little bit about some of the risk areas now, Mark. So in your experience, what are the particular risk areas that could lead to a tax audit?
To me, the most important is sloppy record keeping, right?
Yeah.
Rarely have I seen taxpayers take, crazy tax positions or, try to, understate income to a significant level, because it's going to be hard to find a tax preparer that's going to sign a tax return with, a tax position that is completely agrarious, right?
Mm-hmm.
However, you can have a plain vanilla tax return, your income and expenses, no crazy tax positions, no, significant income being excluded, but you're not keeping adequate receipts for your expenses, or you can't support any of the deductions that you're claiming. You're going to get them all added back. So a simple filing I've seen been tripped up with just really sloppy record keeping. If there's loans, for example, or even loan related party loans or loans to an entity or loans from a family member, but folks are sloppy. There's no loan documentation. It's not paid back on a regular basis. There's no stated or adequate rate of interest on the loan that you would have made to a third party. The IRS comes in and says, look, that's not really a loan. We don't, we're any, interest might be disallowed or, could result in an add back to taxable income. So my biggest advice to clients is, keep good records, especially if you're dealing with related parties, have everything documented. If it's a loan, make sure payments are made. And because it's the simple things that you can get tripped up on.
Absolutely. All right. So we've covered a lot about tax compliance, Mark. So let's talk a little about tax planning. All right. You've seen thousands of businesses, I'm sure, in your 20 plus year career. From a tax planning standpoint, what's your wisdom advice around how should businesses approach tax planning? What are the basic things they should look at to ensure that they're planning and managing their taxes as efficiently as possible? What are the key things? Talk about maybe 3 or 4 of them. At the outset, you would look for XYZ from a tax planning standpoint to ensure that they're paying taxes as efficiently as possible.
So some of the low-hanging fruit is if you're operating as a pass-through entity, make sure you're taking advantage of this QBI deduction that I talked about, this 20% deduction for pass-through businesses.
Yeah.
If you're operating as a C Corp and you're selling internationally, certainly look at this. It's called an FDII deduction. So that's the deduction that drops the corporate rate from 21% down to 13%.
Yeah.
There's also some nuggets. If you're an exporter of product that is more than 50% U.S. content, there's an export incentive. It's called the interest charge DISC, Domestic International Sales Corp, where a certain amount of profit from that operation can be routed through a separate entity that's not taxable, and you can actually get a good tax deduction on those payments. It sounds too good to be true, but it's out there. It's called the DISC, D-I-S-C.
Mm-hmm.
And that it's been around since 1962, I believe, but you'd be amazed as to how many taxpayers don't take advantage of it.
Yeah.
And I would say, keep in mind, if you're going to exit, say after 5 years, look at this, evaluate should you operate as a C corporation or as a pass-through? Because as I said, you get this, qualified small business stock exclusion for sales of C Corp shares. And that's something that a lot of people are not really considering up front. I mean, that's something that you should really look at up front as part of your overall strategy for the business. And the basics, if you're going to be taking profits out of the business on a regular basis, maybe a C Corp is not for you, or pass through might be better. Those are sort of the basic blocking and tackling types of strategies that you can look at.
Those are awesome. And so many listeners here, Mark, are probably the type who have grown businesses. They've gotten to a certain size and scale. They're probably thinking about some type of, equity raise, whether it's, some type of venture capital or maybe private equity, or maybe even thinking about a liquidity process by going public or so. would your advice, would your top 3 or 4 main things to look at remain the same for those type of companies who are looking to maybe get into the PE world and attract some investment from the outside?
Yeah, I guess it depends, but PE companies are, typically coming in to, sort of control the business. So it'll be more than 50% type of control that you're giving up.
Yes.
So just make sure you're ready for that when,
Yes. Yeah.
the cash is great up front. But typically, the way these deals work is, you sell a portion of the business, sort of partner up with the PE firm, grow it, and then you can sell out the rest and get a second bite of the apple. But you do lose a certain element of control in that case. A lot of PE firms, they have their businesses or their invested businesses pass through type entities. So if you're operating as a C corp, that's something to consider as well. But I guess my advice on that is, start thinking and planning about this stuff, a few years in advance of when you're actually looking to do it. Because if you need to convert an entity type or operate under a different structure, you'd have some time to do it, as opposed to trying to do it all within a 6-month time frame without the pre-planning that you need to do.
Absolutely. Well, that planning is everything there. And so, you hear about tax-free exchanges, you hear about, preserving step-up basis and so forth. So just break it down, Mark, just very simply for those who are kind of building wealth, maybe through a private equity acquisition of some sort or some type of merger and acquisition. What are the top 1 or 2 things they should look at? Because they could be coming into significant wealth. And there are many of the entrepreneurs like that in Florida, right? What are the 1 or 2 things they should be looking at about, making that as tax efficient as possible?
Well, the idea of a tax-free like-kind exchange really is for real estate now. There used to be for other items prior, but now, like-kind exchanges where you can, sell a piece of property and replace it within 6 months, and defer the gain on that sale is really for real estate types. Now, normally, if you're exiting, the best rate that you can hope for is really capital gains, right? I mean, the tax rate on capital gain is taxed at 20%. There's a 3.8% Obamacare tax.
Mm-hmm.
So, if you're operating as a pass-through structure, most acquirers typically looking to buy the assets of the business as opposed to the shares, or because there's no liability sort of coming along with the shares of the company. But whether you are selling shares, if you're the seller and you're selling shares versus assets, the tax consequences could be very different to you as a seller. So I would say, depending on, your tax costs of the assets relative to your investment in the company. And, these can be good negotiating points where, depending on the structure of the sale, the buyer might want something, or a share sale or an asset sale, because they get tax benefits, but it may be detrimental to you as a seller. So those types of issues, definitely hammer out up front and understand what your tax bill is going to be.
Got it. Okay. And it all comes down to the planning, as you said, Mark, right? Way in advance, not on December 31st, 100%. I understand what you're saying. Okay. This is brilliant, Mark. Thank you. And so, what is your parting advice for setting up a legal entity and tax planning for a business? And I've got a follow-up question to that.
So I've seen a lot of clients just run and grab an entity type because, maybe their brother-in-law told them this, or, someone told them this at the, family lunch. Take the time, speak to an attorney, even if it is briefly, and, speak to a tax advisor and sort of make sure the entity type is aligned for both. And before you run out and incorporate, because oftentimes I've seen that there's the type of entity or the taxation associated with an entity is discovered after the company's been formed, right? So you really want to talk about this stuff before you do it.
Absolutely. And you mentioned one point, which was, different types of exit strategies, but one of them could be just intergenerational wealth and passing that on. Is there a particular, entity type that lends more to people who at the outset, no, it's not necessarily change of control to private equity, but I want to pass it on to next generations? Is there an entity type that basically favors that from a tax planning standpoint?
I wouldn't say an entity type would favor one over the other. One of the major considerations in doing that is, estate tax planning, right? Because normally you want to take this stuff out of your estate and pass it on to your loved ones with a proper estate planning strategy. And there are a number of there's some very technical ways to do it. I probably, this is not the forum for it, but it could involve setting up different types of trusts. So I would say it more likely would involve moving the shares of whatever entity you have into some type of a trust vehicle or multiple trusts as part of that estate planning. But that would be very, very key.
Got it. Okay. All right. And part B to that question, Mark, are there any case studies, just maybe one or two, or real life examples you can share where the choice of business entity had a significant impact on the company's financial success?
Yes. For example, I had a client that they were set up as an S corporation, right? And I'm an international tax practitioner, so a lot of sort of the planning opportunities I see, there's some international element to it. And the company was, 100% of the company sales were international, 100%. And in addition, the profits were pretty much left into the business to try to grow the business. And the owner took a salary. And what ended up happening is he was paying taxes at, north of 30% on company profits, even though they were never distributed to him. Whereas if he had operated under a C Corp structure, the taxation of that would have been somewhere between 21 and 25%, or actually less than that. It would have been closer to 16%.
Yeah.
So, there was a 13 percentage point, unnecessary expense that was being incurred every year just because you were not in the proper entity type. So you see that more often than you would think.
And I guess the moral of the story always is, Mark, as you said 2 or 3 times so far in our session, is just pre-planning. The tighter you are as regards what your long-term goals are, and so on, and you plan accordingly. All right, this stuff you could see some dividends. Excuse the pun on that one, but there could be some serious, cash and tax implications, right? Just by proper planning, right? For the right.
Absolutely. Just be intentional about what your exit strategy is, what your exit timeline is, what you really think you need to take out of the business versus leaving to grow. All of those factors are going to determine how you set up the business from the get-go. And I would say it's always easier to set up properly up front than to set up, operate for a year or two, and then change. There's going to be additional costs associated with that, and sometimes tax burdens, just from changing entity types.
Absolutely. And as you mentioned before, Mark, have a good set of books, clean set of books, all right, where this stuff could be handed over. Invest accordingly in the right level of resources. And equally important, invest in the right, tax advisor as well, right? You don't have to go this alone. You can save plenty money by doing all of that right up front than facing the consequences later and just going on your own and doing things that are tax inefficient,
Absolutely. Absolutely. Proper planning, as we said about 20 times during this doing this part.
Well, Mark, thank you so much. This has been tremendous. I know we've unpacked a lot. We could go on for days about our tax code and what to do and what not to do. Every business has a kind of individual character and different nuances, right? But I think we covered the bare basics on this one. But thank you for that. This has been some wonderful wisdom bites here.
Absolutely, my pleasure. And we'd love to do it again. So we'll see each other soon.
Thank you so much, Mike. I appreciate it. Thank you.
Right, thanks.
Bye-bye.
Thanks, Richard. Take care.
Bye-bye.
Bye.